Today on Compound Insights, we're talking about water investments, equity and bonds in the private markets. We're going to look at the diversification and correlation these investments have and also the uncertainties that the sector faces. I'm Rob Rowan. Our guest for this podcast is Matt Desario. Matt is a co-founder of Water Asset Management, which invests globally in water-related companies and assets. Prior to this, Matt was the portfolio manager of global long-short equity funds at Schaefer Cullen and was GP and portfolio manager of Water Street Capital. Those of you who have been to the ESG conference in the past might remember Matt and his partner speaking at both of our lunches. Matt, I think you and your team here have taken an audacious position that climate change is bad. Could you tell our listeners about that?
Yeah, we are very much focused on trying to cut through a lot of the complexity around the discussion related to climate change. And quite simply, the primary negative impact of climate change is its effect on the hydrological cycle. It intensifies drought and flood. And our focus on investing in companies and assets that ensure water quality and water supply is that those companies and assets can actually anticipate and solve drought and flood related issues while at the same time generating very attractive, non-correlated, long duration, inflation protected returns for investors.
Mm-hmm. So let's talk about that correlation and the immunity to disruption that these types of investments have. So investments to solve water problems for society seem to have some of those things. Could you give us an idea of how uncorrelated they are and how limited, say, technology disruptions are to them?
Yeah. The companies and assets that we invest in and the listed equities that represent those companies and assets are essentially investor-owned water utilities and wastewater utilities, long-duration water and wastewater concessions, companies that manufacture pipes and pumps and meters and membranes and build and manage desalination plants, as well as water resources, i.e. water rights, and water technology. And your question about the risk for disintermediation or disruption is it really barely affects the water industry, because if I own a company that owns the pipe that goes from a water treatment plant to your house or your office building, what can replace that? Nobody's going to be coming into that city or that service territory and tearing up all the streets to put in a competitive water transmission network. It's just not going to happen. And if you look at companies like Uber, for example, or Amazon, and the disruption that they're causing in the industries of transportation and retail, there's nothing that's technologically driven that is going to disrupt foreseeably the centralized distribution water and wastewater systems and networks. And, it's like what we say is that, the companies and assets we own are going to be there and generating high visibility, inflation protected cash flows, not only in the next 10 years or 20 years, but in the next 50 or 100 years. And that it's very hard to say that about other industries. I mean, think about it. Is Exxon going to be pumping as much oil and gas in 20 or 30 years as they are pumping today? I mean, maybe, but maybe not. Right. Are pharmaceutical companies going to be making, the same kinds of drugs that they're making in the next 50 years? Is technology. I mean, obviously the disruption and replacement curve is very, very accelerated in those kinds of industries. In water, it's extremely high visibility. It's extremely durable. It's all inflation protected for the most part, and the ability to replace it with something new really doesn't exist. If you need water, water is what you need, right. And you can't replace it as you can, for example, with with electrons. I mean, you can generate electrons a lot of different ways,
right.
And we can talk about that, in terms of water
Heat,
versus
motion,
exactly, water versus other types of utilities, and why water is so unique.
Mm-hmm. Well, we have seen, one of the reasons I was asking about that and differentiating that is because we have seen technological disruption start to impact some subsectors that we never saw before. If you look at for instance, the impact on the automotive companies and the cost that they are going to have to assume to switch to battery production is phenomenal. And Mercedes and some of these other countries have given those pretty tight time frames, which cost them in their stocks. So, but it's true. I think most utilities have water infrastructure in place, put a pipe in the ground for 25 years or 50 years. Most of them
100.
Yeah, 100 years.
Literally, yeah.
But you did mention in one of the areas of investment you make in is technology, and I would argue the desalination is sort of part of that, because the desalination has a long way to go, and most of its success could be in technology because it's kind of expensive right now. But could you talk about the technology investments that you make and what types of things those are in the sector?
Technology investing in the water industry has been extraordinarily difficult to make money up until very, very recently. And the reason is that where water is not priced to cover its full costs of delivery, there's very little incentive to adopt and implement innovative technology. In some places, water is priced appropriately. Wherever an investor-owned water utility is delivering water and wastewater services, those services are priced not only to cover all the operating and maintenance and capital equipment and cost of debt and equity capital costs, but also, as I said, just to generate a return on that equity for investors. In those kinds of in those places, there's the adoption of innovative technology. But in many, many places where water systems are owned and managed by government entities, where pricing is not covering its full cost, there's a tremendous unwillingness to implement innovative technology. Mm-hmm. That makes it very hard for innovative technology companies in the water industry to get traction and grow earnings. Now, that said, there are some very interesting things going on around water quality, temperature, turbidity, and flow analytics, and then the very significant amount of data that those miniaturizing sensors are generating, and the ability for that data ultimately to enable both water systems operators as well as industrial operators that are heavily dependent upon water supply and water quality to manage their plants and systems much more efficiently and anticipate water quality and not figure out they've got a different kind of water quality than they thought they had when it's already in the plant and they have to shut the plant down.
Right.
So that's one area, for example, that's very interesting. Another is around different kinds of hydrophilic membranes, different types of nano filtration media. These are all areas where there's a lot of development and innovation occurring, but the uptake is still slow. It's not like TMT or healthcare, an industry that's scrambling to find the next greatest thing. Water is very slow to adopt, and that's why most of the investing that we do is around investor-owned water utilities, companies that manufacture pumps, pipes, meters, and all those goods and services that keep water systems operating correctly and functioning properly, as well as water rights. We're a very active investor in water rights in the southwestern United States, as well as in Australia, which are really the two places on Earth where an investor can own water rights. And I'm happy to kind of describe that a little bit more.
Yeah, I do want to talk to you about how you all are doing that, and particularly how you're addressing the structural water scarcity in those places, because I think that's really interesting. But because we have some people on the podcast, you might not be familiar with water turbidity. So the water desalination plant that was most recently constructed in the United States was in California,
yep.
And that was funded through PPP, I believe. Is that accurate?
Yeah. It was a private equity infrastructure equity and debt deal.
Okay.
That was ultimately, the financing was driven by a long-term take-or-pay concession with San Diego County Water Authority.
Okay, so it's take-or-pay, yeah.
Yeah, and it took well over a decade to get that done, and it's extremely expensive water.
Right.
and it's very high carbon water.
Right, because if I understand the challenge of reverse osmosis correctly, it's basically you get a pump that pushes water through a filter.
Through a membrane.
Yeah, a membrane. And,
Yep.
and that basically attracts the salt and the other minerals to it.
Yeah, it blocks this. Think of it as almost like it's a semi-permeable membrane, and it literally blocks the salt and then diverts it to an outtake, and then what you're left with is drinking water. But the efficiency ratios on a lot of these desalination plants is like basically 50%, give or take.
Right.
And so you have a very large brine effluent stream, brine-intensive effluent stream that also has to be dealt with.
Right. And then there is the carbon production that is required to run the pumps.
Yeah, it's an extremely energy-intensive way to generate drinking water.
Right.
And that's why, and in certain parts of the world, it's a better alternative. In the southwestern United States, including California, it is not the best alternative. Mm-hmm. It's not even close to being the best alternative. I mean, if you look at that one plant generates about 50,000 acre feet of water per year, and the West needs 10 million acre feet of water per year. We will not desalinate our way to water supply reliability in the southwestern United States. And we don't have to, because there's a tremendous amount of water in the southwestern United States. 80% of the water in California, Arizona, Nevada, Colorado, Texas, et cetera, is used in agriculture. And that agriculture only generates about 2 or 3% of the region's GDP.
Right.
And so our focus and one of our investment strategies, and where we have a separate team and fund structure, that's executing, is to bring market efficiency and transparency to very select water rights that are part of that 80% that have they're the best water rights in the West that are hidden or embedded in low-value cropland. So in other words, farms that have historically used the best water rights in the West to grow alfalfa or grass hay. And what we do is we buy those farms with those best water rights really hidden in that low-value crop farmland, and then we do a development strategy which ultimately, where we do permit changing in terms of the consumptive use, mm-hmm. and we implement fallowing programs, mm-hmm.
which
conserves, up to 50% or even more of the water on that farm, which then enables us to enter into long-term take-or-pay contracts with other higher beneficial consumptive users like cities,
right.
or residential communities, or industry or energy, as well as the environment. One of our investments is creating augmented in-stream flows to benefit 4 different endangered fish species in a very specific sect or reach of the Colorado River. And that's, all the while, generating what we think will be a unlevered 20% IRR for our investors.
Mm-hmm. Yeah, that was actually what I was going to ask you, is what type of change does that make in all the metrics from when you go from start to end in that? Is that like a multiplier of some proportion to the profitability of the plant, of the farm?
Yeah, so basically the underwriting target that we utilize in that one strategy of ours is we seek, well, as I mentioned, to generate a 20% IRR, but it reflects a multiple on invested capital of between 2 and 5 times.
Wow.
The issue for us in that strategy is time.
Okay.
And how we, ideally compress time between our asset acquisition, our asset development, and then ultimately the asset monetization. Those are the 3 obvious steps of that we're focused on.
So is that a 7-year type of thing, like a venture capital type of thing?
Yep, that's a separate fund structure a private equity fund. It's a 10-year fund. Mm-hmm. With a 3-year investment period and a 5 to 7-year development monetization period on a total life of fund life of 10 years.
Okay, and is there a drawdown phase in that?
Yeah, it's a 3-year investment period drawdown, and there's just because a lot of people will say, well, gee, is that a scalable strategy? We have $500 million of pipeline of investment opportunities that we are ready to execute on. We're raising. This is our second fund. We first closed with about $85 million. We're targeting $300 million to close on this fund. And what we love about this strategy is, we're targeted these 20% unlevered IRRs, but what's equally important to us and our investors is that the downside on each individual investment is extremely limited because we only pay the value of the farm as a farm with these embedded water rights. So we're not paying any premium. So if we don't monetize at our targeted underwriting, value, I mean, what's my downside? My downside is I've leased the farm the day I bought it. I'm getting a 2, 3, 4, 5% cash on cash yield with no crop risk. Underlying farms in America have appreciated at 3 or 4%, 5, 6%, depending upon the 5-year rolling average cycle for like the last 50 years.
Right.
So my downside is sort of an unlevered, 6 or 7 or 8 or something like that on an individual asset. And the upside is a, targeted 20. And so when you risk adjust the return potential and you look at the distribution of returns that we're ultimately going to generate on this, it's a very, very attractive strategy on a risk-adjusted return basis. And it delivers low-cost, scalable, sustainable, reliable, perpetual water supplies to one of the most important economies on Earth, as well as to a number of different environmental needs. So it's a great combination, just like all water investing is, of market-beating return potential with measurable positive impact.
Well, one of the things that was never really calculated into the forecasts for farms was the impact of the trade deal. And I know the trade deal is an uncertain future, the trade war, I should say, has an uncertain future, and it's, the impact is limited to soybeans and a couple other things. Are there trade risks to those farms? I'm just trying to think through the risks.
Yeah, no, that's those risks to farms generate positive buying opportunity for us.
Right.
So what that has done is it's helped keep the actual farm value of the land and water that we're buying, which is basically CAGR'd, compounded appreciation over the last 10 years at sort of 1 or 2%, very much in line with what I just described.
Right.
Whereas the underlying price of the water, when we're successful, has compounded at 10% plus. So the spread, the arbitrage between what we're doing has widened considerably. And, with the uncertainty of trade wars depressing the value of these assets with these great water rights hidden in them, it's really creating more opportunity.
Right, because the spread is bigger, essentially. Yeah. Interesting. So what other risks are there to this strategy?
The risk really is time. The risk is time that affects our IRR. As long as we can, continue to do, which is what we do, which is be very, very selective on the buy and make sure we don't overpay beyond the value of this very specific water right and farm is as a farm. The financial risk is pretty limited. I mean, and part of what we do is very, very driven by the collaboration that we seek with the local farm community. And because often the way we structure our exits is in a way where the other farmers in the community actually participate with their farm and water rights in some of these exit monetization strategies. So it's very, very collaborative in terms of, by the way, we do all this before we even commit any capital to make sure that these are resources and these are assets and that are where there's a great willingness to do what it is that we're talking about, which is ultimately implement a fallowing program, conserve some of that water, and then monetize some of that water to the benefit of not only our investors, but also for the community as well.
All right, well, let's spin the globe a little bit and go to other parts of the developed world that also have scarcity issues. I'm thinking of Australia now. You all have made some investments there as well?
We have. We own the two places in the world where you can own water rights are Australia and the southwestern United States. And by the way, a water right, just for everybody's benefit, what is a water right? Well, a water right is a legally entitled piece of property that gives the owner the right to consume a certain amount of water in a certain location with a defined beneficial use and then with a certain seniority, just like a capital stack. There's senior water rights and junior water rights. We only buy senior water rights.
Okay.
And the senior water rights are like at the bottom of the river. So if the volume of the river fluctuates up and down, the junior water rights may not get them in a particular year, and they know that. The senior water rights always get the water. And by the way, when these water rights were created, and in the U.S., these assets that we're acquiring are literally over 100 years old in some cases, it's like a cap and trade model. They measured the flow of the river, and they allocated less than the annual average flow, and then they structured seniority on that allocation. So we get questioned a lot, well, gee, what if, the river runs dry? Well, the river's not going to completely run dry. They are fluctuating, and that fluctuation what it's done is it's begun to create separation in the value of the senior versus the junior water right, and which before really didn't exist because there was not really that big of a difference because the river flowed and the junior water right got his water kind of pretty much the same way the senior guy did. Well, that's changing now. Right. So there's this separation that's occurring, which is creating real enhanced value.
Right.
And
a AAA premium, if you will.
AAA premium. It's funny you say that because the way we describe this, it's like buying AAA bonds at junk bond prices.
Right.
And ultimately the spreads, like everything, will narrow.
Right.
Timber, when it was initially kind of recognized asset class, the returns people were getting there were, mid double digits. Now they're, 4 or 5. Same with solar. Now you underwrite solar, you get a 3.
Right.
Before it was a 20.
Right.
Same with water rights. Right now we're getting, we can do 20s. Ultimately, these will be 4% assets because unlike every other asset that I can think of, they're perpetual. A water right is a perpetual asset. It's not a 20-year, 10-year, whatever. It's a perpetual asset. It's managed and in a sustainable way, and you can create cash flows that are literally multi-decade long, that are backed by what I believe is an appreciating asset where, and this is what makes them very, very unique, there's zero capital intensity. So I could own a building, good asset, leases roll over and protect me from inflation to some degree. But at the end of, 50 years, I've had to replace the windows maybe, or, whatever, the boiler, whatever. And by the way, at the end of 50 years, the building may have to come down. I may have to replace the building.
Right.
Or, if I own a power plant and I have a take or pay contract, obviously that's a great asset as long as I'm getting a good, return on my capital. But, the turbine needs to be replaced. Or at the end, of the 30 or 40 year, that plant's not going to be worth a heck of a lot.
Right.
A water right, I would argue in 30, 40, 50 years is going to be worth more, number one. And number two, there's zero capital intensity. And because of that, we believe we're going to be able to create some of the most unique, long duration, capital free, inflation protected cash flows that exist.
So how long do you think that is before the spread narrows?
It's, we're on fund 2. We think that'll be like fund 8
okay.
or something like that.
Okay.
It's not happening anytime soon. And the reason is that where we are in the understanding of water as an institutional asset class, it's like one out in the top of the first.
Okay.
It is still very, very early days. And we just have very little direct competition for what it is that we're doing.
Right. Is there a regulatory risk in the long run that water levels will drop so much that the government will step in and say, okay, you know what, those contracts are different
so when
now,
you're investing in water, which is is literally a perpetual asset, whether you're investing in investor-owned water utilities or water rights. Regulation is not a liability. Regulation is your friend.
Because it controls the price, right?
Because what it does, the quick answer to your question is, it's not going to happen. Because in the U.S., if the government, quote unquote, wants your asset, they can take it.
Right.
But they got to pay for it.
Right.
It's called eminent domain, as I know you know. And there's a whole, very, very well-established process through the judiciary where the price the government pays is the highest and best use value. And instead of going to court, we're a seller. That's kind of the whole. So what we're doing, pro not prohibits, but creates a dynamic where if the government if a government entity is interested in a water asset, there's a deal to be done. That's the whole point of what we're doing.
Yeah, and I think that what has happened to some of the other utilities is difficult to imagine here. So no one expected when the Tennessee Valley Authority was building coal-fired plants all over the place that natural gas would become so effectively cheap and the public sentiment would change so much that natural gas would become a thing and they would have to stay all of those plants, or a significant number of them.
More than half the coal-fired plants in the U.S. have been shut down, and Mayor Bloomberg, through one of his foundations, I was just at a conference that they hosted earlier this week, has committed $500 million of his own money to make sure that the other half of the coal plants in the U.S. are shut down by,
Right.
I think it's 2030 or something like. It's pretty soon. Absolutely,
But that seems
and that kind of game-changing alternative resource risk that you have in energy, if you're an energy-focused investor, does not exist in water.
Right. That's what I was saying. This is hard to conceive of how that might happen. Okay, so that's a lot on the private markets, and some of the people on the podcast have clients who do not have access to the private markets because of their asset sizes. Now, there are lots of opportunities in the public equities markets, and I know you all have been active investors there. So could you tell us about your experience with that?
Sure. Yeah. Since we started in 2005, we've been investing in listed water-related equities in about 25 different countries. So we invest in emerging markets, but all developed markets with a good rule of law and good regulatory regimes and liquid markets. So no frontier markets. There's about 250 stocks that that are in our opportunity set. And as I mentioned earlier, they're companies that are either investor-owned water utilities, which are regulated monopolies, essentially allowed to earn a return on equity of about 10% indexed to inflation forever. Companies that make pipes and pumps and meters and membranes and water treatment chemicals and water-related technology that we were talking about earlier, as well as some water resources as well. And we manage a fairly concentrated portfolio where our top 10 positions are generally about 50% of our gross exposure. We manage both long-only as well as long-short funds. And we've had our returns, which have beaten both the S&P and the MSCI All World on the long-only, as well as the HFRI from inception. We've had those returns analyzed by a number of different entities in terms of to identify the alpha generation. And we have been about 70% of our returns come from idiosyncratic stock picking. And the reason for that is, the concentration, obviously our stock selection. We're very active managers, i.e., we've tendered for one of our companies when the stock went down. We took the full company private. We've done a number of different proxy fights, solicitations. We just actually did one this year. We, are active in terms of, letter writing around capital allocation issues to boards, and we interact very, kind of actively with boards and managements of the companies that we invest in. And we think that helps create some of the self-fulfilling returns that we've been able to generate for, a pretty long period of time.
And how do you go about the shorting?
Well, the shorting, because there's such a positive macro for water-related investing. There's a multi-trillion-dollar capital investment supercycle underway to replace and repair water infrastructure and ensure water supply after generations of underinvestment and neglect. So how could you short in that environment?
Right.
So the answer is that because water is so highly operationally segmented, and while it's an enormous industry globally, it's all local. That operational segmentation and the localization of water creates for some of the highest dispersion in the annual returns of water stocks, certainly more than the S&P, but it's actually more than healthcare or technology as well.
Okay, so how do you do analysis on that?
Oh, so
because it's super local, right? So
yeah. Well, we travel a lot, and we've been doing it a while, and so we have a great familiarity with these different markets and these different operational segments within the water industry. And so what we end up doing on the short side is we identify those companies where the business models are susceptible to the opposite of what we look for on the long side. So where pricing pressure, we like companies that have, and there aren't, they're more select than they are on the long side, but companies where competitors are using pricing aggressively to gain market share, where we're able to identify the deterioration of a business model initially as a CFA, you'd know this, initially on the balance sheet, then in the cash flow statement, and finally when it shows up in earnings per share in a quarter, that's usually when we're covering.
Okay.
And
that's the plan. Anyway.
Yep, that's usually the plan. We're very clear to monitor, people flows. We like to follow good people going to companies, and we like to follow bad people bad managers going to companies. We've done that. And it's usually those businesses in the water industry that are more on the, more on the commoditized aspect of the water industry. So we also are able to generate, great returns by monitoring very closely hydrology, for example. Where certain companies that are in the water distribution business might be facing, severe drought and then are unable to deliver the amount of water that they've have historically, which impacts earnings per share. So it's a combination of all the things that come from having invested in the sector for a very long time, and our short alpha is extremely high. We're very competent short sellers.
Yeah. It's fascinating because you don't hear short strategies combined with concentrated portfolios very often, but in the dispersion you described, it seems entirely as well. Yeah. Well, this has been a wide-ranging podcast. Thank you, Matt.
My pleasure.
And thank you all for listening in. CFA New York has events on water and other commodities roughly twice per year, so please find out about them by visiting our website and clicking events. I'm Rob Rowan. Until next time.